John, when you look at inflation, the inflation in the US is tricky, and you either believe the Fed and you say, look, it's just lagging, but it's there, it's what, 6-7 months away, or you actually think, well, the bond market and the flattening of the yield curve means there's something more disturbing out there.
Yeah, I mean, last year they were saying a stronger dollar, lower oil price, some slack in the labour market was the justification or the explanation of why inflation was soft. Now they sort of can't say any of those things anymore. And they're still saying it's idiosyncratic, it's going to end, wage inflation is going to come through, there is going to be a pickup. And the market, I suppose the jury's out if you look at where the front end's priced and so on. There's been quite a material rise in front-end yields over just recent days and weeks, which tells you the market perhaps is sort of becoming more convinced about the view that inflation is going to become higher in due course. But, nobody, as indeed Chair Yellen was saying, can be certain about that, which is why I think they're right to tread carefully.
Simon?
I'd slightly differ with John on the steepening of the front end of the yield curve. I think it's more not that the bond market has become convinced that inflation is returning, but more that the Fed will be inflation agnostic as they have been this year. I mean, I put my cap on the table and say, look, I expected the Fed to move once this year. Looks like they're going to now move 3 times. But I got the inflation call right, but the Fed have moved beyond sole data dependency and starting to worry about a broader basket of factors. And if that prevails into 2018, it has to say there's a lot of uncertainty. We don't know most of the composition of the FOMC for next year, so it's a very difficult environment to call. But I personally don't buy the fact that inflation is going to return sustainably at 2% in the current environment.
Okay, what does it mean for the curve? So this is actually a really interesting chart, probably my favorite one, because we're pitting the 210 gilts with the 210 treasuries.
Yeah, very well matched. You could put a third one on there, which is the bunds as well, which have actually decoupled. They've gone in the opposite direction. As everything has flattened in the US and the UK, actually bunds have remained, at least to date, very flat, believing the Eurozone growth story more than the US and UK. But I think what's interesting around the back end of the US yield curve is there's still a ready number of buyers at yields of 2.3, 2.4, 2.5% outside the UK, outside the US. And therefore, given there's no sign of a buyer's strike, no concern of a write-down in the values of those bonds, it's very difficult to see it steepening at the back end in the way that it's steepened at the front end.